When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. Marcus with Shawn Hackett. This edition of the Moving Iron Podcast. Shawn is here to talk about what's going on in the world of commodities. So, Shawn, how you doing today?
I'm good. Back from South Dakota. I had a few presentations, went really well, and I'm back home for the rest of the month, and looking forward to some family time for sure.
Right on. So was South Dakota pretty similar to South Florida? Is it pretty close to the same thing?
Because of my dyslexia, yes.
Right. Good answer, Shawn. Good answer.
Because I saw 38 and I said 83, which is pretty similar to what it is here. Yeah. So everything was fine, other than I needed a winter jacket to stay warm.
Just that 83 felt a lot colder than 83. And
it was the one night it was 15 when I woke up in the morning.
Yeah.
It was a little chilly. Pretty typical for South Dakota, though. Yeah. Nothing unusual.
Balmy.
It was clear, though.
Yeah.
It was clear, so I didn't have to battle any snow, which I can take cold all day long and just keep the blizzards away from me.
Yeah.
So
we've had a pretty mild weather pattern. I mean, it's been cold, but I mean, as far as moisture kind of rolling through the area, you talked about this a little bit earlier. You know that central east weather pattern that we'd see. You're starting to see some of that. More rain and those kind of things pop up in the central in the plains area.
That snow event in the northeast that kind of surprised everybody. It's late this month. It's really going to kick in. We got a sun traffic warming event now. We're going to have a second one later in the month, and that's really going to create wild disruptions of the polar vortex. And because it's an El Nino Mordecai, it's going to drive that pattern into the eastern half of the country versus the western half of the country that we had last year. So it's just a flip. It's going to be a warm east, a warm west, cold east, and a fair bit of snow in the east. Already we're seeing record cold in Northern Europe, Eastern Europe, and of course Russia is still looking at 100-year record cold temperatures. That's going to start moving into Asia and China. So the cold air is there, and it's just a question of getting it aligned to come into North America, which we've said for a long, long time. Late December is when everything's going to line up for that to happen, and then it's going to be a pretty cold 3 months. Jan, Feb, March. A fall spring's coming for April, meaning we're going to have a nice warm up. The planters are going to rock and roll, and then we're going to have the highest risk for a late spring hard freeze in probably 20 years, according to our work in that let's say first half in the middle of May, that could cause considerable havoc for winter wheat and obviously for early planted soybeans and corn, but especially corn, because the corn crop is the planters like to roll early for corn versus soybeans. So
correct. Yep. Yeah. So it'll be interesting. This is going to be a different pattern that we've seen here the last couple of years.
Very different. Yeah. I mean, really, really different. And remember, because we're looking at an El Nino ending and the La Nina coming back, it's exactly opposite from last year when the La Nina was ending. El Nino was so everything is just kind of, we're kind of doing this year, and doesn't mean it's going to be exactly opposite, but definitely not going to be looking. We're going to be looking at some pretty significant different weather patterns for sure, without question.
Yeah, for sure. Right on. So we've got a question from a listener, and his name is, or his or her name, I'm not for sure. Hill Country 11 says, you're delivering information. Unlike most YouTube channels, you have guests that offer more than talking their book or opinionated rhetoric. Thank you. We would be interested to hear what Shawn thinks about the weather and crop conditions of our wheat crop in the U.S., both hard and soft wheat, and then also what your price outlook might be on them.
Well, first of all, when you look at wheat, you just can't look at the U.S. You got to look at the global wheat picture. It's a global market. You can't make a price forecast on just the U.S. alone. Quite frankly, we're fifth most important now in the world. Russia's number one. So that's the first thing. I'd say you got to focus on everything. So I'll answer the question this way. First of all, we know that just because crop conditions going into dormancy are poor doesn't mean that you're going to have a poor crop. It doesn't mean that at all. There's a lot of examples of very poor conditions going into dormancy, and we had a very good spring, and everything turned out just fine. Now, having said that, obviously, if you go into dormancy with poor conditions, the risks are higher that if weather isn't actually perfect, that you could have problems. So when I look around the world, Russia is seeing excessive rainfall during dormancy, and that's not good for quality at all. In fact, it's deteriorating quality considerably. Europe is going through very much the same kind of very, very wet pattern into dormancy, very poor conditions declining as we speak, as the dormancy phase goes forward. The U.S., I'd call the U.S. conditions, certainly SRW, not very good compared to where it's been the last few years. For HRW, better. But of course, the last 2 years, it was so bad. I mean, it's hard not to be a little bit better. But overall, I don't view the conditions of winter wheat here in the U.S. terribly good. And if we have that late spring freeze, it really doesn't matter what the quality is, because that's going to be a devastating blow to winter wheat coming out of dormancy. So when I look at the world, Australian wheat, terrible shape. We already know that the wheat crop in Argentina, terrible shape. And we know that Russia's finally backing away from exports. They're finally deciding to back away, to sell less, not hit the bid every single time. And without them selling, there really isn't a lot of wheat in the world at this point. So we have our smart money algorithm that we created that goes over capital flows, is getting this probably the second or third strongest buy signal we have seen ever. And we're in the top 5 percentile of smart money buying that we've ever seen. So it tells me that every bear is on the one side of the boat in wheat. And of course, we're down 60% from the highs. Usually when everyone is on the same side of the boat, something happens to cause the market to decide that they're on the wrong side and have to go the other way. So we're in a very unique position right now that tells us to watch out for some explosive upside heading into spring. In fact, we saw a nice update yesterday. We're seeing another nice update today in winter wheat. So I like the prospects for wheat right now. If you're somebody that is sitting with wheat, I would be very reticent to sell right now. I'd be more looking at marketing opportunities as we move into the springtime. If you have to sell, if you don't have a choice but to sell, I find a way to keep my top side open on those sales by, doing something, doing some protection to the upside with, hedging and such. So, like the prospects for winter wheat a lot from a whole host of reasons, and I actually think that we might have completed this extended multi-month bottom that we've been developing. This could be the week, the turning point week, where we turn the market up and begin an uptrend here. It's been a long while that we've seen anything good on wheat, but we might actually be at an important inflection point here. So keep an eye on that.
Right on. Well, thanks for the question from Hill Country 11. Send me your address, and I'll send you a little gift for sending that email in. So I appreciate that. If you have a question like that for Shawn, make sure you hit him up, send them your way, and we'll make sure we ask those questions on the podcast when we record, or anybody for that matter. Send a question, we'll do that. All right.
Yeah, questions are great. I love questions. I think that's always good to answer what's on the mind of people out there versus what we happen to think is important. I'd rather answer what they think is important, but definitely I think having some questions at Q&A is I know when I go out and speak at conferences, Q&A is very, very beneficial to everyone in the room.
Yep.
So
yeah, Q&A is great because it, like you just said, it gives you the pulse for what everybody's looking for at that point. So, right on.
And it's like a lot of times people have questions that is on their mind, but they're afraid to ask it, and then somebody asks it, but it was on everyone's mind, right. And then everybody gets what they were afraid to ask.
Yep.
It's so anyway,
it makes a big difference for sure. Absolutely.
Yeah. Yeah.
All right, let's jump over and talk a little bit about what's happening in the cotton market. Well, first off, let's do this. You already kind of hit on a little bit about the buy signals that you're seeing kind of pop up out there. You sent one out to your a report out or a text alert out yesterday, kind of going over that. Kind of hit on the corn side of that a little bit. That was part of that alert.
Yeah. For those who don't know, we've developed a smart money algorithm that utilizes back testing, commercial speculators, small speculators, commercial operators, and we've been able to develop which one of these constituents typically buy most at the lows and sell most at the top, and we call it our smart money algorithm. And every market has a DNA marker that every time we get to a certain level, historically it's occurred at an important either top or bottom. Never use any one indicator in isolation. We always use it as a part of weather and other things that we're looking at, but it's an important indicator. And what we indicated in our text alert to our customers and subscribers yesterday was that both corn and wheat saw activity in the last few weeks that's pushed buying of smart money at levels that are in the top 5 percentile of historical precedent. That means that the buying has reached a very unusual level of strength that constitutes us to be wanting to be thinking that what we're dealing with here is the end of a low and potentially the beginning of something more protracted to the upside. And so once we get that kind of a reading, we just look for technical indicators that tell us the market's turning up. So like what wheat did yesterday and what wheat's doing today, we're getting close to breaking the chart pattern to the upside. That's like another trigger that tells you, the smart money timing is on and something is about to happen here. Because remember, they know things I don't know, you don't know. And that's what's important, is that we can't know everything, but if we can follow the capital going in and out of our markets, and we can time that with some other factors like weather, geopolitics, currencies, and technicals, it gives us an idea of when physical buyers should be being a little more aggressive, or when producers need to be more aggressive selling their cash production. So our highlight yesterday was, if you're on the buy side of corn and wheat, physical buyers, and we're getting this kind of a signal, Casey, it says to me, you need to be getting more aggressive with protecting upside price risks to lock in an economic advantage.
Right on. Okay. Let's jump over and talk about cotton here for just a minute. So cotton, not like it's a big surprise here, but we haven't talked about it for a little while. But looking at the cotton market is down right now. It's trading down about a penny at 78 cents a pound. If you take a look at where it's been at, kind of historically, we've seen a kind of over the last, I don't know. November is such a bad month for every commodity. It seemed like that, we had some sharp drop-offs in the price of cotton. But as you're looking at there, it's kind of bouncing back, but it's kind of hovering in that high 70s, low 80 range, kind of bouncing back and forth there. Shawn, as you take a look at the cotton market, your thoughts as we move into the end of the year, cotton harvest just kind of got wrapped up in most places. Well, they're still kind of going after it, but mostly it's wrapped up in a lot of places. As you look at that cotton market right now, what are your thoughts there?
You'll have to remember, it's a cyclical commodity.
Sure.
It falls well before economic weakness. It rises well before economic strength, meaning it bottoms when things look absolutely awful. economically, and it tops when things look absolutely amazing economically. You have to be able to buy when you don't want to and sell when you don't want to. That's what a cyclical stock, a cyclical commodity, anything that's cyclical, that's the nature of the pattern. So, cotton topped out a year ago, well before the current consumer economic weakness we're seeing now that's really, really caving in. But it's been falling for over a year, Casey. This is not, so we're getting ready for the Federal Reserve and central banks of the world to start lowering rates and printing money, especially in election year. It is going to come sooner than anybody thinks right now, because from what I can see, the consumer demand side of the equation is in collapse mode right now. I was on airplanes half full. I haven't seen that, Casey, in a long, long time. A half full plane going to Florida from Denver is typically, they're telling people you want to take a ticket for $600 for another flight because we overbooked half a flight. So there's definitely, I think we're going to get some shockingly disturbing news on consumer activity, and the Federal Reserve is going to start lowering rates. And that means the cotton market's going to start going up well in advance of the improvement in the economy. And the improvement in the economy needs to start happening in this back half of 24 as elections come out. So if that is the case, then we should see the cotton market starting to put some kind of a bottom in here and start to work its way higher, into the first half of 24 in anticipation of better demand coming in the back half of 24 as monetary policy and governments do what they always do, is they throw money around to try to buy votes. And so, and remember, we had horrible crops globally last year in cotton, terrible crops. So the supplies are not really very good. If we get any kind of better demand at all, Casey, the supply side of the equation can't absorb a lot of increase in demand. It'll very quickly get into a situation of not enough supply versus the demand that's out there. So I like the cotton market here. If I'm a physical buyer, if I need to buy cotton, I think this is a place that you should be adding to your physical coverage and locking in what I think in hindsight is going to be a pretty good, solid economic price. I think this 75 to 80 cent area on the nearby price, I think this is an area that this market's going to dig its heels in and start turning itself up. The minute that the Federal Reserve starts to tell everyone that they're going to start lowering rates, the cyclical commodities like cotton, like crude oil, like copper, for example, they're going to start moving very, very quickly. So the way these cycles work, the first markets that move are your monetary assets, gold, silver, then Bitcoin. Your monetary assets have been taking off here the last 30 to 60 days because they're the first movers getting ahead of inflation. Then the monetary levers are pulled, then the cyclical commodities start coming back, like we just mentioned. And then you get your more staple commodities that start coming back. Those are general trends. Of course, within those trends, there's weather and other things that are going on. Remember, we're extremely negative on the U.S. dollar for 2024. We think we could enter to some degree some kind of a crash market in 24 for the U.S. dollar. Currency-led inflation is a powerful, powerful repricing mechanism that even if fundamentals remain exactly the same today, 6 months from now, if we have a crashing dollar, the price of any commodity that's priced in U.S. dollars will be considerably higher just on the currency move alone, having nothing to do with whether there's a change in the fundamentals. If we were to get a change in the fundamentals more bullishly, then you have it in a bigger move. So there's a lot of factors that go into what's corn going to trade for, what's cotton going to trade for. We've been trading a strong dollar and a very restrictive monetary policy and a weakening economy for over a year. Very negative for commodities, and we've been in a bear market for commodities for over a year. If we start seeing the dollar work down, and we start seeing the monetary authorities loosening back, and we start getting better economic activity, now all three headwinds become tailwinds for 2024. That is what we see. And the bearishness in commodities right now in many markets is extreme, the way we're looking at it. So
right on. Okay. A lot of moving parts right now, man. Tell you what, it's very, very weird. I mean, I talked to a lot of people about a lot of different things when you start looking at, we're talking equipment, we're talking economy, whatever it is. And man, I tell you what, it feels like there's more uncertainty in 2024 than there's been in any time leading up to this. And I think as you look at what's going on, as I look at it, it's not so much that people think the wheels on the bus are going to fall off. They just don't know if they need to plan for the wheels on the bus to fall off or plan for a quality, profitable year. So that it's just one of those things where no one knows what the next move is going to look like, and it's all hinging on what this interest rate thing looks like and what the Fed's going to do or not do.
Unfortunately, our system is tied to money supply or lack thereof, the cost of capital or lack thereof. When you are so far indebted as everyone in the world is, all the governments are and all the corporations are and all the consumers are, that controls a whole ball of wax. And, they purposefully have tried to put pressure on all these factors to get inflation down. But inflation is down and it's continuing to fall and it's going to continue to fall. So the inflation monsters, they fixed it. Now they just got to make sure they don't overdo it, and not create an economic, too much of an economic problem that forces them to have to overprint again. And so I hope that they're a little more forward thinking this time and recognizing that in order to avoid their mistakes in the past of overdoing everything all the time, that they need to start lowering rates sooner rather than, doesn't mean going back to 0%. That was nonsense. I hope that never happens again. I'm talking about bringing yields back to 3.5%, for example, down from 5.5%. Right. That would be a reasonable normalization back down that would provide a buffer to the economy. It would ease the cost of capital, and it would go a long way into moving into a more moderate period for the economy to kind of move in a more regular fashion versus what took place with COVID when we had the crash and the boom and all the crazy things that have happened. We need to try to put things, get back into kind of a bottle that's reasonable again. We had this crazy undulation from all these monetary and fiscal craziness that went on. And so I'm hopeful that they realize that moderation here is really what everybody wants. As you said, stability, clarity is, I'd rather have a clear 1.5% growth rate than an unclear, volatile where you go from 5% growth to a recession. I'd rather have more of a steady eddy. People can plan for that than wild gyrations back and forth. It's very hard, as you said, to correctly plan for that.
Yep. So it's a weird time. It's just a weird feeling in the universe right now. So
it is
globally, not just in the United States too. I mean, you take this everywhere. So it's a weird.
It
time.
Is.
All right. Lastly, let's take a look over here at what we see going on in the protein side of the markets. We've seen, again, November was such a tough month on just about everything. Cattle prices, hog prices, and all that stuff just got battered in the month of November. As you look at the protein markets now, Shawn, as we head into what we see happening, the African swine fever, I've read a lot of reports where that's really starting to get into some fears of Vietnam and those areas like that. We're starting to see more Asian countries get that African swine fever pressure. Do you feel like there is a opportunity for export of hogs to really crank up now that we see maybe some more opportunity for rebuilding of herds again in Asia?
It's got to run its course, though. We had a first round of it earlier in the year, and it looked like it ran its course, and we were going to get ready. And then they had another round of it, and so we have to get through that herd liquidation. According to our calculations and looking at the way this typically plays out, the herd liquidation from this round should be over in the first quarter, and then they rebuild second quarter onward. So I think there's going to be an opportunity in hogs from a physical buyer perspective in the first quarter. Until then, it's going to be tough sledding. We're not going to be able to sell much to Asia or China. We have California doesn't want to buy it from those that aren't treating their animals correctly, according to them. And we have pork cutout prices at December 2020 levels. Tell me how many things are priced back where they were in December of 2020. Not a whole lot of things. I mean, it's just a tough period for hogs right now, and I think there could be some more downside. As much as I hate to say that, because they're already experiencing historical losses, I think there could be some more downside into the first quarter. I think most of the downside is over. Let's say 3/4 of it. I think, but I'm not sure we're done yet. I think we might have to price a little more downside. But once we do, and we get our capital flows algorithm and other things kind of lined up, and we see the price of hogs and pork in China starting to improve based upon ASF calming down, then there should be an historic opportunity. I'm not sure we're quite there yet, Casey. I wish I felt we were. I don't think we are. I think we might have one more shoe to drop for hogs and pork prices in the first quarter, sadly to say. Cattle is just different. Cattle rose all last year. It was late to come to the party, and now it's collapsed to a certain degree. Something we warned about, for months, that we thought was going to happen. And it's a cyclical, especially beef is very, very cyclical. Talked about cotton, talked about crude, talked about copper. The beef cutout price has been falling now for almost 3 months straight. The consumer's not going to pay that kind of money for beef now, given their stressed finances. It's just not going to happen. But historically, you don't put a major top in. We put a top in. But the major top usually occurs after we're done herd rebuilding in the U.S. We haven't even started yet. So while I think this weakness and this period of stress can continue in cattle through the first quarter, because we have a lot of cattle on feed that have to come through the system, I think once we get to the second quarter onward and we start legitimately getting the herd rebuilding cycle going, then your animal availability is going to shrink even tighter than it was last year. And if we start lowering rates and we start printing money and the government starts handing money out to buy votes and the economy looks like it's going to do better, beef demand is going to come back when there's no animals. So that says to me the back half of 24 looks like we could have another exciting period for prices, but you have to get through the valley of the shadow of death right now, which is what we were trying to avoid cattle producers from having to absorb, is to have to eat what was a tremendous margin a few months ago. If they didn't take action, now they're just looking to sell, bounces along the way to try to get some better advantage. So not very excited about the next quarter, but I'm very excited about cattle prices in the back half of 24. So if I'm on the physical buy side of cattle, I'm looking for opportunities here in the first quarter to lock in, a long-term economic advantage, whether you're, JBS or you're, any of those packing houses. There should be a really good opportunity here in the first quarter, I think, to lock in some good economic advantage on cattle. Same thing for pork. It's just the difference in pork is, we just have the ASF equation that we don't have going on in cattle at this point. So there's a little bit of a more complicated situation. And you'd have, I don't know why the U.S. consumer doesn't want to buy and eat pork more readily, given how cheap it is. Maybe we don't want to. I mean, have we lost our interest in pork as a consumer? Is the flavor not there? I hear a lot of people in the industry that know a lot more about it than I do that say that the U.S. producer went for efficiency versus flavor, and that we're very efficient, but we're producing a product that's not flavorful, and because of that, the consumer's not acting in a manner that you would expect them to act economically. I'm not knowledgeable enough to know exactly to the extent that is true, but from some people I really trust, that is what they're telling me, and that the way to get the hog industry turned around is to start going for flavor and quality more so than efficiency. And, usually economic distress forces action in industries to do something different than what they've been doing, because obviously if you need to create more flavor to create a better pork cutout price, and if that was what needs to happen, then the best producers are going to do that, and they're going to stay in business and they're going to make a better product. So that's the hope going forward, that through this, the industry can be that much better coming out of it.
I dig it, man. All right, Shawn, good stuff as usual. If folks want to reach out to you and get more information about what it is you're doing at Hackett Financial, what's the best way to do that?
Our website is Hackett, Hackett, advisors with an S.com. Twitter page at FaradX11. We have a LinkedIn page. From time to time, we'll put interviews up there. We'll make some comments about a few things. We're not habitual posters, but from time to time, we do try to give you some insight on some of the things we're looking at, especially our climate work that gives, we think, our customers an edge in long-term hedging and cash marketing. So
check that out, guys. If you have a chance to go check out Shawn's site, man, make sure you do that. There's a ton of great information there that you can find a lot of good information on there. So check that out. Shawn, appreciate you being on the podcast, man.
Always a blast, Casey. Always look forward to it.
If you want to send a question in for me to ask Shawn or any other guests on the Moving Iron podcast, you can find me on Facebook, Twitter, and Instagram at Moving Iron LLC. You can go to Snapchat at Moving Iron Podcast. You can go to LinkedIn at Moving Iron Podcast. You can go to TikTok at Moving Iron Podcast. You can go to the YouTube version of this and Moving Iron Podcast. Check it out there. And you can send all your questions in that way. Or you can go to movingironllc.com, and there's a contact me page there where you can send your question as well. So you want to send me an email at movingironpodcast at movingironpodcast.com, and I will respond to that as soon as I can. So, you have a couple big announcements coming out here over the course of this month and going into next month that I'm pretty interested to share, and hopefully I'll have a new website up here in January that'll be even more fantastic for your internet viewing pleasure. So check that out there. So with that, I'm Casey Seymour with Shawn Hackett. Let's move some iron, folks. Out.
Moving higher in the 21st century.